jumping straight into MicroStrategy today. Everyone is watching the price action, but the real story is their massive Bitcoin treasury and how it's driving their entire valuation.
Exactly. You're tuned in to the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
Make sure you subscribe and hit the like button so you never miss out on our analysis.
Yeah, we've got a fascinating one for you today. Our goal is to really unpack this wild corporate transformation.
Right, because we are looking at a legacy enterprise analytics firm. I mean, this is a company that survived the dot-com bubble of the late 90s.
Which is crazy to think about.
It is. And then a few years ago, they take this massive pivot. They essentially transform their entire corporate structure into the ultimate leveraged proxy for crypto.
It's totally unprecedented in modern public markets. You just don't see established software companies rewriting their financial DNA like this.
No, you really don't. And today, we want to explore that staggering upside potential that has everyone captivated right now. But also, we need to talk about the extreme volatility risks you absolutely have to grasp if you're tracking this space.
Yeah, because it fundamentally changes how we even categorize this stock at this point.
Exactly. And to understand why it's completely dominating the news cycle, we have to look at the immediate market context. I mean, on March 4th, 2026, shares rocketed 10.8% in a single session.
10.8%. That is a massive move for a company this size.
Right, and it didn't happen in a vacuum. It was directly tied to the digital asset surging to near $73,000, specifically hitting $72,907.
Which was a 7.7% gain in just a 24-hour window.
Yeah, and when an asset moves like that, it tends to grab every single crypto-linked equity by the collar, right? Just drags them straight up with it.
Let's break that down even further, because understanding that specific relationship between the digital asset and the stock is the absolute key to understanding the entire company right now.
It's their defining feature.
Exactly. They've effectively built what might be the most unique competitive moat in the modern financial era. Their primary advantage isn't just their enterprise software anymore. It's holding the title of the largest corporate holder of the asset on the planet.
So if you're looking at their traditional competitors, say a pure software company like Tableau, those guys are battling it out purely over software features.
Right. User interfaces, enterprise sales contracts, that kind of thing.
Yeah, but MicroStrategy is offering you, the investor, something completely different now.
They are offering what Wall Street calls uncorrelated alpha.
Let's unpack that term for the listener.
Sure. It essentially means you're getting an investment return, the alpha, that doesn't just blindly follow the traditional stock market or the standard tech sector. It kind of dances to its own macroeconomic beat.
It's a dual engine model. You get the steady operational cash flow of a legacy software business, but then they layer on this massive, explosive upside leverage of a crypto treasury.
Right. But you might be wondering, if you're a massive software competitor and you see this stock going to the moon, why can't you just take your excess cash tomorrow, buy a bunch of digital assets, and copy their homework?
Yeah, why not just replicate it?
Because the barrier to entry right now is almost insurmountable. To replicate what they built on their balance sheet, a competitor would need a staggering amount of capital intensity.
You'd have to raise billions and billions of dollars in debt or equity just to reach their current starting line.
Exactly. All while trying to maintain a profitable software business without terrifying your traditional shareholder base. This model protects them from multiple angles.
It fends off pure software peers who don't have the balance sheet leverage.
And it fends off pure crypto mining companies, because miners have massive constant hardware and energy costs to deal with. MicroStrategy just has to hold the asset in a vault while their software division keeps churning out recurring revenue.
Which brings up a really important question. Underneath all this treasury hoarding, they actually still have a day job selling software. Are enterprises still buying it, or is the software division just a side hustle at this point?
Oh, the software side is very much alive. Recent filings actually show accelerating demand in their enterprise analytics division.
Business intelligence software, right?
Yeah, exactly. It's what massive corporations use to make sense of their data. Imagine you're a global retail CEO, and you need to know why shoe sales are dropping in the Midwest but rising in Europe.
You'd use their tools to visualize those answers.
Right. They pull from millions of rows of corporate data, and right now their fourth quarter 2025 revenue projections are looking incredibly strong.
I have to imagine that's heavily tied to the massive artificial intelligence boom we're seeing across the whole tech sector.
It's a huge part of it. They are actively integrating AI into those business intelligence tools. So instead of a data scientist spending 3 days building a complex dashboard, an executive can use AI-driven natural language processing.
Just literally ask the software a question and get a visualized answer instantly.
Exactly. And because of these cloud-based AI tools, they've been running a leaner, much more effective software operation,
Expanding their profit margins.
which generates the vital cash flow they need to fuel that broader corporate strategy.
Okay, let's talk about how they actually fuel that strategy. Because free cash flow from selling software alone does not buy billions of dollars of digital assets that quickly.
No, definitely not.
If a normal software company has expanding margins and extra cash, they might pay a dividend to you as a shareholder, or they might buy back their own stock. MicroStrategy does neither of those things. How exactly are they affording this massive accumulation?
They treat their balance sheet like an aggressive sponge. It's designed to soak up as much of the digital asset as legally and financially possible. And the primary engine they use to fund this is convertible debt.
Let's translate that for someone who doesn't spend all day reading bond prospectuses. What exactly is the mechanic of convertible debt here?
Think of it like a highly specialized corporate mortgage. The company borrows massive sums of money from institutional investors, and in return, they pay a relatively low interest rate.
But the convertible part is the kicker, right?
Yeah, exactly. The lender has the option, down the road, to convert that loan into actual shares of the company's stock, usually at a premium to whatever the price was when the loan was issued.
So it allows them to borrow billions to buy crypto today without immediately printing millions of new shares and diluting the value of the stock you might already hold in your portfolio.
Precisely. It pushes the dilution down the road. The investors buying this debt get a small, safe yield, plus essentially a lottery ticket on the stock going up.
And for the company.
Well, if the underlying digital asset appreciates over time, issuing that debt looks like an absolutely brilliant financial maneuver. It allows them to continually expand their treasury while rolling over their financial obligations.
It really is a masterclass in financial engineering. But it's built entirely on the deep conviction that the digital asset will consistently appreciate over a multi-year horizon.
And looking at the raw data, Wall Street seems to be buying into this dual-engine narrative. We're seeing incredibly optimistic outlooks from major financial institutions.
Yeah, the consensus average 12-month price target is sitting at $505.47.
Which is staggering when you consider that recent trading levels were hovering around $289. That implies Wall Street is anticipating massive upside.
It gets even wilder. You have specific firms like Benchmark publishing highly optimistic price targets of $705.
That's a huge premium.
It is, and what's fascinating about their reasoning is that they aren't just looking at the crypto treasury, they are pointing directly at that software division we just talked about.
Right. They view the company as a top artificial intelligence stock, benefiting from explosive growth in analytics, paired with a massive crypto recovery play.
It creates the perfect narrative storm for the market. You have the AI boom driving the underlying operational business, and the crypto supercycle driving the balance sheet valuation.
And when both of those engines are firing simultaneously, institutional models start generating those eye-watering price targets. The market is basically pricing in the flawless execution of their software strategy alongside a perfect macroeconomic environment for digital assets.
Which sounds amazing when the charts are entirely green. It means we are looking at a company engineered for absolute maximum velocity when conditions are favorable.
Looking at the flip side,
Mm-hmm.
we have to address the sheer volatility of the asset class that serves as the foundation of this entire strategy.
Right, because velocity doesn't only travel upward. It is easy to get caught up in the massive gains, but we have to remember that earlier this year, specifically since January 2026, the asset suffered a staggering 22% drop.
That is a brutal drawdown in a very compressed time frame.
And because of how the company's balance sheet is constructed, analysts refer to the stock as a high beta proxy.
To simplify the concept of high data for you, it basically means the stock acts like a giant magnifying glass for the underlying asset's price movements.
So when the digital asset goes up, the stock tends to launch higher and faster.
But when the crypto market catches a cold, this stock gets pneumonia. A 22% drop in the underlying treasury asset can trigger panic selling in the equity, making the stock drop even further than the crypto itself.
Does that intense volatility stay contained to the stock price, or does it actually bleed over and cause headaches for the people trying to run the day-to-day software business?
Oh, it absolutely bleeds over. We noted earlier that their AI-driven cloud tools, or creating operational efficiencies. But the harsh reality is that their core software profit margins are actively pressured by this extreme volatility.
Because you're trying to manage a traditional corporate budget while your primary asset swings wildly in value by billions of dollars month to month.
Exactly. It creates accounting complexities, impairment charges, and operational hurdles that traditional software competitors never have to think about. The core business is profitable, but the headline financial numbers will always be completely hijacked by whatever the Treasury is doing that quarter.
That brings us to the actual risk of the debt itself. The company has a massive market capitalization right now, sitting around $44 billion. But that valuation is resting on top of a mountain of that convertible debt we discussed earlier.
They've taken on substantial multi-billion-dollar financial obligations to fund this Treasury. To go back to our real estate analogy, it's akin to taking out multiple mortgages to buy a highly volatile portfolio of speculative properties.
As long as those property values keep surging, you look like a visionary, and the monthly debt payments feel manageable.
But if the bottom falls out of the market, if we enter a prolonged multi-year crypto winter, that debt load suddenly becomes an existential threat.
Because no matter what happens to the price of the digital asset, those debt payments still come due.
Right. If the market goes cold, the free cash flow generated by their enterprise analytics division might be entirely consumed just by servicing that debt.
Leaving them with virtually no capital to reinvest in their AI tools or compete in the software space.
That is the ultimate execution hurdle here. The management team has to perfectly thread an incredibly tiny needle. They have to run a highly competitive, AI-driven software enterprise while simultaneously managing the largest corporate digital asset treasury in the world.
Any misstep in how they structure or roll over that debt could be catastrophic to the value of the equity.
Definitely. And we also need to highlight some of the warning signs flashing in the broader financial ecosystem surrounding this stock.
Yeah, there's a fascinating yet incredibly cautionary situation playing out in the derivative market right now regarding the Yield Max ETF linked to this company.
This is a textbook example of what happens when financial engineers try to manufacture a steady, reliable income stream out of an asset defined by extreme chaotic volatility.
For those who might not be familiar, this particular ETF uses complex options trading, essentially selling the rights to future stock gains to generate a high monthly cash payout for its investors.
But recently, this specific ETF's distributions completely imploded.
They plummeted from paying out $4.42 all the way down to a mere 30 cents. If you were relying on that product for yield, your income just evaporated overnight.
And the reason this matters to you, even if you'd never dream of buying a complex derivative ETF, is what that implosion signals to the broader market.
It signals severe fragility in the ecosystem.
Exactly. When derivative products start fracturing or failing to deliver their stated goals, it proves that the underlying volatility is reaching a fever pitch. It reaches a level where even sophisticated financial engineering models break down and fail to smooth out the ride.
But just to play devil's advocate here, does the failure of a peripheral third-party ETF actually pose a direct threat to the company itself?
Not directly. The company's core treasury and software operations remain completely insulated from those specific derivative blowups. As long as they can continue accessing capital markets to roll over their corporate debt, their immediate liquidity remains sound.
But you have to view that ETF failure as a massive flashing yellow light.
Yeah, it illustrates just how speculative and highly charged the environment surrounding their equity has become.
So with all of this on the table, the massive upside momentum, the AI software growth, the towering leverage, and the ecosystem fragility, what are the immediate catalysts you should be watching over the next 30 days?
The single most important date on the immediate horizon is their upcoming first quarter earnings report, which drops in late April 2026.
What specifically should we be looking for when that press release hits? Are we focusing on software sales or treasury numbers?
Both. But Wall Street will be hyper-focused on earnings beats driven by the crypto treasury. You want to look for upward revisions in their earnings per share estimates.
Because we saw that massive surge in the digital assets price throughout Q1.
Right, so their headline numbers could be highly inflated compared to historical software industry norms. You really have to read past the top-line number and see how the core software business is actually performing underneath those treasury gains.
Beyond the quarterly filings, what about the rumor mill? Because this stock tends to trade heavily on sentiment and forward-looking catalysts.
You definitely need to tune your radar to the unconfirmed market chatter. There is constant speculation regarding potential new corporate purchases. The market is always trying to predict the exact moment management will announce another debt offering to acquire more assets.
And what about regulatory stuff?
Keep an ear out for broader ETF approvals across the globe that could indirectly impact the demand for the company's treasury strategy. And because the management team is highly vocal, you should absolutely look out for major investor updates at upcoming industry conferences. They frequently use those stages to signal their macro view and future purchasing intent.
Speaking of the macro view, we cannot ignore the broader economic environment. You have to tie this specific corporate strategy back to what the Federal Reserve is doing.
You do, because this company thrives under very specific macroeconomic conditions. You need to monitor the continuing recovery from that earlier 22% drop.
While the asset showed incredible resilience by snapping back recently, that inherent volatility remains the heartbeat of the stock.
More importantly, keep a very close eye on rate cut expectations.
Because if the Federal Reserve cuts interest rates, capital becomes significantly cheaper to borrow across the board.
Exactly. Broad sector rotation into crypto proxies could uniquely benefit their leveraged exposure over the coming months. If rates drop and capital gets cheaper, their existing multi-billion-dollar debt becomes much easier to manage and refinance.
Plus, in a low-rate environment, speculative assets traditionally see massive inflows.
It creates a macroeconomic tailwind that could supercharge the leverage they have already built.
It truly is a perfect storm of variables intersecting at once. So, pulling all of these threads together, how do we synthesize this entire situation for the listener?
The core tension you need to understand is this. MicroStrategy is fundamentally a legacy software company that has brilliantly, yet with extreme risk, transformed itself into a highly leveraged crypto behemoth with an unmatched corporate moat.
Balancing the reliable cash flows of enterprise AI software with the massive debt-fueled accumulation of a volatile digital asset.
The ultimate high-wire act in modern finance.
It really is.
And it leaves us with a fascinating, provocative thought to ponder as we watch this narrative unfold over the coming years. If this high-leverage treasury playbook proves undeniably successful in the long run, if it becomes widely accepted as the gold standard for creating unprecedented shareholder value in a new digital era, what happens if other major global tech giants decide to replicate it?
Just imagine a world where the titans of Silicon Valley, companies sitting on tens of billions in cash, start adopting this exact balance sheet strategy.
If the biggest, most cash-rich companies in the world begin funneling their massive free cash flows into that same limited supply digital asset, we face two wildly diverging scenarios.
On one hand, would MicroStrategy suddenly lose its unique market premium because it's no longer the only institutional game in town offering that uncorrelated alpha?
Or on the other hand, would a mass corporate adoption trigger an unprecedented supply shock for the underlying asset, sending their already massive treasury valuation into a completely new stratosphere? It's a scenario that could fundamentally alter the entire landscape of corporate finance forever.
That's the lowdown on MicroStrategy. Keep a close eye on the market's next moves, and thank you for tuning in to the Easy Money Show.